U.S. natural gas futures climbed about 4% to a 23-month high on Friday on forecasts for slightly cooler weather and higher heating demand over the next 2 weeks than previously expected, and an increase in the amount of gas flowing to LNG export plants so far this month. With the front month up about 15% over the past 4 days and in technically overbought territory for the first time since November, the premium of futures for January over February climbed to a record high of 30 cents. Meanwhile, meteorologists projected weather in the U.S. would remain mostly warmer than normal through at least January 4th. Moreover, average gas output in the United States rose to 103.1 billion cubic feet per day so far in December, up from 101.5 in November. Average gas demand in the U.S., including exports, would rise from 124.4 this week to 130.2 billion cubic feet per day with cooler weather next week before falling to 119.4 billion cubic feet per day with milder weather in 2 weeks. The use of gas to produce LNG for export, the fastest growing source of U.S. gas demand growth in recent years, was headed for its first annual decline in 2024 since the country started exporting the superchilled fuel from the United States in 2016. On a daily basis, a drop in LNG feed gas to Cheniere Energy's LNG Corpus Christi plant in Texas to a 3-month low offset a rise in flows to Cheniere's Sabine Pass in Louisiana to an 8-month high and a rise in flows at Venture Global LNG's Plaquemines plant in Louisiana. Meanwhile, Morningstar analysts forecast that North American gas markets will likely remain subdued through early 2025 due to several key factors. First, underground gas storage inventories in the United States are higher than average as the winter season begins. Second, the potential for warmer than normal temperatures throughout much of the U.S. during the winter could suppress heating demand. Third, industrial and commercial gas consumption remains relatively weak, with recent interest rate cuts requiring more time to stimulate demand meaningfully. Lastly, production from major U.S. basins remains resilient despite reductions in gas-directed capital spending. Together, these factors are expected to keep storage levels at or above normal throughout the winter, exerting downward pressure on prices in the near term. The recent price spike appears to be largely speculative, likely sparked by Donald Trump's statement on Friday. He suggested that the European Union could face tariffs unless it takes action to reduce its growing trade deficit with the United States, proposing significant purchases of American oil and natural gas as a potential remedy. This rhetoric has likely injected a dose of uncertainty into the market, prompting traders to react swiftly to the potential implications of such tariffs on international trade flows and energy markets. While the statement itself does not guarantee immediate policy action, it has stirred concerns about potential shifts in geopolitical dynamics, which may be contributing to the sharp uptick in prices. Speculative trading in response to these comments underscores how sensitive the market can be to even the suggestion of significant policy changes or trade restrictions. Gas prices broke through significant resistance levels in the last session, with the $3.45 mark now acting as potential support. A move above the $3.65 resistance could pave the way for a stronger rally. However, the likelihood of a downside correction is high at this point. If prices fail to maintain levels above the $3.65 support, a pullback toward the $3.45 threshold could be triggered, warranting caution for traders. I find this scenario likely, with a higher chance of a warm shift than a cold spell, given the unpredictable weather patterns and frequent temperature swings in recent years. Moreover, the downside correction seems highly probable, as the current price spike appears to be driven by speculative activity. Please like, subscribe, and comment to support the channel. See you in the next one.